rubbing hands together with a smile, a clapping motion. Okay. Like this. Is this okay? We are about to finish this course. We have reached the climax of ancestral knowledge necessary to master the Darwinex ZERO ecosystem. Joking aside, however, in this video, we aim to uncover the workings of this company's primary and most significant asset, its risk management engine. Why is a risk management engine needed? What purpose does it serve? Which factors does it consider? How does Darwinex ZERO determine this risk? And most importantly, how does it benefit us as traders? Disclaimer. We begin. The risk management engine serves as an additional protective layer for the prospective investor. Specifically, this engine defines and assures the investor a maximum risk for their invested capital of 6.5% VaR monthly at 95% confidence. A topic we've covered many times on this channel. But what is this VaR, and why 6.5% and not 8% or 10%? What does 95% confidence mean? Before we learn how Darwinex ZERO calculates VaR, let's review the concepts and explain the origin of these figures. If you're already clear on all this, I've included timestamps in the video player below so you can skip directly to the second part of the video. If not, stay here. Let's go. VaR stands for value at risk, the value at risk. A statistical technique commonly used in the capital management industry to measure the risk of potential losses that an investor might suffer in the future when investing in a specific asset, a trading strategy, or a fund that operates various financial instruments. To do this, three variables are measured: the magnitude of the loss, the probability of loss, and the time horizon over which that loss could occur. Darwinex ZERO sets the loss amount to be between a minimum of 3.25% and a maximum of 6.5% of the invested capital. This is the percentage the company decides to configure for all investable indices. And why is 6.5% the maximum? It's because this is the average risk exposure for S&P 500 investors over the past 20 years. In other words, the S&P 500 serves as the benchmark against which we can directly compare any Darwin on the platform, since any of them operates with the same risk as this asset, which is highly useful for making investment decisions, such as whether to invest in the S&P 500 or a particular Darwin. In 2024, the S&P 500 registered a return of 23.3%. Consequently, investing in any Darwin that outperformed this benchmark would have been a superior choice, as that Darwin would have, as the saying goes, beaten the market by achieving a greater return with equivalent risk. Regarding the 95% confidence, well, no one possesses a crystal ball. The future is unpredictable, so discussing risk involves contemplating potential future scenarios. We are discussing probabilities. Defining the confidence level involves adjusting the likelihood of a specific event occurring. In this instance, we are establishing that our Darwin will not experience losses exceeding 6.5% of the invested capital in 95% of cases. And what times are those? Well, in this case, months. That is, if we were invested in a Darwin for 95 months out of 100, we would not lose more than 6.5% of our invested capital, or equivalently, that in 19 out of 20 months, we would not lose more than that amount. Does this mean in those 5 months out of 100, or that 1 month out of 20, we will lose over 6.5%? No. It's just a possibility. But it doesn't necessarily have to happen. The probability is low. It might occur or it might never occur. Probability. Over what time horizon? Well, we've already mentioned it. Monthly. So, the risk management engine operates in two phases or levels. The first level is precisely this default management that it performs by calculating the 6.5% monthly VaR at 95% confidence. The algorithm continuously feeds and learns from the risk taken in your operations during each trading session. Once the risk management engine has performed this calculation, a specific multiplier will be assigned to you so that your trading operations are replicated in your Darwin, adjusting to a risk that is between 3.25% and a maximum risk of 6.5% monthly VaR. Protecting the investor. As we've been discussing, keep in mind that this calculation is dynamic, meaning it updates once a day with each trading session, so it may change. However, the key is not to become fixated on these potential changes. The important thing is to always trade in the most similar way possible in terms of position size and duration to maintain proportionality between the profit or loss in your signal account, in your trading account, and the profit or loss obtained in your Darwin. Keep this in mind. We'll explain why later. For now, let's examine in detail how Darwinex ZERO calculates the VaR. But before that, I remind you that if you haven't registered on Darwinex ZERO yet, in the video description below and in the pinned comment, I'll provide the links with the discount already applied, 20% off the monthly plan and an extra 5% for the plans covering 1 and 3 years. Let's see how the VaR is calculated. Come on, okay, at this point, let's remember that our strategy's VaR is calculated each trading day, meaning once a day, provided there has been market exposure. The VaR of our underlying account, by the way, can be seen in this graph here, within the Strategy Analysis tab. Excellent, Darwinex ZERO, to calculate the value at risk for your trading strategy. Today it will take all the positions you have executed in your signal account during the last 45 days of trading. You might have executed 20, 100, or even 2,500 positions. All of them will be considered within that 45-day trading period. Great, let's suppose you've executed 30 positions. The Darwinex ZERO algorithm will then follow these 5 steps, which we'll cover next. Watch this part carefully, don't miss a thing. Step 1, it will take those 30 positions and classify them by duration and deleverage. This deleverage concept is unique to Darwinex ZERO, which we'll see later, but for now, just remember that it refers to the leverage employed in the trading position. Step 2, it will conduct a Monte Carlo simulation with those same $30 positions. In other words, Darwinex ZERO needs to take the risk of a known asset, in this case the euro-dollar, to reference all the calculations it will perform and, therefore, replicate in its case, for the euro-dollar, those duration and leverage conditions for each of the 30 positions, to simulate them in a random manner. This last detail is crucial. We're not simulating if we bought or sold based on our position, but only the duration and leverage that we have historically used throughout those 30 positions that we have taken in the last 45 days. I know I'm repeating myself, but this can be difficult to grasp. Step 3, okay, this random simulation in the euro-dollar will yield a profitability curve X. It can be positive or negative. Again, I remind you that we work in terms of probability, at a 95% confidence level. This means we are proposing an alternative and random scenario for the euro-dollar's price trajectory, while maintaining the same duration and leverage values from the positions being studied, which in this case are yours. Step 4, Step 3 is repeated 9,999 more times. That is, Darwinex ZERO performs a total of 10,000 random simulations. Each of them will yield a different profitability curve as a result. If you don't have statistical and probability knowledge, this might not make much sense to you, so focus on this. The greater the number of simulations, the greater the precision in the confidence level. At that defined 95% confidence probability. And then, where does today's VaR figure for my Darwin come from? Step 5, each of those 10,000 simulations will have yielded a specific risk for the strategy. And depending on what? Well, depending on how the euro-dollar price fluctuated randomly for each of the simulations. Essentially, Darwinex ZERO orders those 10,000 simulations and retains the risk from simulation number 9,500. And that is the current risk it defines for your Darwin. This, which may seem very arbitrary, is mathematics, it's probability. Clearly, this isn't a calculation guaranteed to be 100% accurate. It's not a prediction of your strategy's future risk. Rather, it's an approximation of the potential risk your strategy might face, based on the historical risk data assumed over the past 45 trading days. This method using random Monte Carlo simulations is employed because, as mentioned at the video's start, it is one of the most used methods in the industry to measure the risk of any financial asset. And I repeat, we cannot pretend to predict with exactness the risk of this or that asset because nobody knows the future. But we can create the most precise approximation feasible. Through this process, the Darwinex ZERO algorithm continuously learns about your trading activity. It adjusts daily to the risk you take in your underlying strategy, aiming to minimize the Darwin's risk and continuously safeguard the investor. Regulatory bodies require companies to calculate risk weekly. However, Darwinex ZERO performs this calculation daily. In other words, they work at a higher precision level than what is regulatorily required. And all this for what? You might ask. Because based on the VaR you assume today, a multiplier is assigned to you with which the risk management engine will replicate your operations in the Darwin. This represents the initial management layer that Darwinex ZERO applies passively or by default to your trading, reflected in your investable index. In your Darwin. And if this fails, then the closing rate comes into play. But we'll leave that for this video. See you in the next one.